In our first segment of the chapter, we talked about when to record revenue, whether it's FOB shipping point or FOB destination. We record it at the time we provide the good or service. In addition, we talked about recording contra revenue accounts to arrive at net sales. Well, it's extremely important we record revenue in the appropriate period as well as those contra revenue accounts, because if we don't, it allows the company to manipulate their revenue. And the company that makes Roundup did just that. So there's an example in the textbook that discusses it. But in short, the company that makes Roundup was recording revenue at the gross amount in one year and then recording any discounts they were providing to their customers in the following year, which artificially inflated revenue in the year of sale, making the company look like they're selling their goods for more than they really are, increasing their overall profitability, and then leading investors down the incorrect path, thinking that the company is doing better than it really is. So you don't need to memorize anything about this. You just need to be aware that improper revenue recognition is the number one type of fraud that companies would orchestrate. So it's extremely important that as a user, you're always paying attention to how companies are recording their revenue and related contra revenues. And the auditors going in to verify the numbers need to also make sure that the company is properly recording things in the appropriate period. Because if you record these revenues or contra revenues in the incorrect period, it could result in income being materially overstated or understated depending on what the company's incentives are. So it's really important that these items get recorded in the appropriate period, because if not, investors will make inappropriate decisions. With revenue recognition up to this point, we've kept it relatively simple, and we're going to be able to keep it simple for this class. Basically, what I mean by simple is that we just record revenue when we provide the good or service. However, it's important to note that in the real world, things aren't always that simple, and there is a more complex revenue recognition standard that recognizes 5 different steps that are involved. And this really applies when you sell goods and services as a bundle. So assume Apple sells an iPad for $500, $450 of which relates to hardware and essential software, and $50 of which relates to future software upgrades that will be provided over 5 years. So the first step is to identify the contract between the company and the customer. And in this case, it's the bundled iPad and future upgrade services. Then we have to identify the performance obligations. And in this example, it would be providing the hardware and essential software on the iPad. And then the second obligation would be providing future upgrades. Then we determine the transaction price, which is $500, and then allocate it between the performance obligations, which in our example here is very easy because it told us in the problem $450 was for hardware and software, $50 was for the future upgrades. Why does this matter? Because step 5 is recognize revenue when the performance obligation is satisfied. Well, we satisfy the performance obligation for the hardware and software when we deliver the iPad. So $450 is recognized in revenue right away, but the remaining $50 is going to be an unearned revenue until we provide those software upgrades. So we're going to end up recording revenue of $10 each year for the next 5 years as a result of that component of the sale. Again, on the exam or quiz, we're not going to get into this level of detail, but you should be aware that in the real world, it's not always as simple as just, oh, we provided the good or service, record a revenue. A lot of times you have bundled packages like this. Probably a better example that you would relate to would be buying an iPad with Apple Care. So then the iPad would be one performance obligation, making good on Apple Care. The warranty that Apple provides would be another performance obligation. So we'd have to allocate the transaction price among those obligations. Our receivables can be classified in 3 common ways: accounts receivable or notes receivable. An account receivable is less formal. It's basically when a company sells something and tells the customer you could pay us later. A notes receivable is more formalized by using a loan document, and it usually involves the payment of principal and interest. So, for instance, if I went and bought a coffee somewhere and I didn't have cash and they said pay me later, they would have an account receivable. But if I went and bought a car and I didn't have the money and they said pay me later, certainly they're going to require that I sign a lot of documents, and I would have a loan involving the payment of interest. So that would be a note receivable for the car dealer. Receivables can also be classified as trade and non-trade. Trade are receivables resulting from the normal, ordinary course of our business. Non-trade would be from transactions other than normal sale of merchandise or services. So, for instance, a company could advance their employee their salary, and then they'd have a receivable from the employee. That would be considered a non-trade receivable because it's not part of a normal business transaction. And then receivables can also be classified as current, which are receivables that we're going to receive within the next year, or non-current, which means we're not going to receive them for more than a year. Usually non-current receivables would be a note receivable, because if we're giving customers more than a year to pay, chances are we're going to have interest involved in that transaction. We're effectively loaning the customer money for an extended period of time. So now what we're going to do is talk about deadbeats. What happens when customers don't pay? How do we deal with that? Well, companies keep a separate account receivable account for each customer in what's called a subsidiary. The amount on the balance sheet represents the total of all of those individual customer accounts. We need to track the receivable balance by customer because we need to know who owes us the money. It's not enough to know we're owed $100,000, let's say. We need to know who exactly owes us that money so we can go after them if they don't pay. Bad debts result from customers who don't pay the amount that they owe, regardless of the collection efforts that we might make. If the customer's bankrupt, we're not going to be able to get our money. The expense recognition principle is what makes this a little tricky under accrual basis. It requires that we record the bad debt expense in the same accounting period as the related sale. The thing about it that makes it difficult is at the time of the sale, we don't think we're selling to a deadbeat. If you sell something to somebody and you know they're not going to pay you, you haven't really sold anything. You've given a gift. So at the time of the sale, we believe that all of our customers are good and they're going to pay us, but we know from past history that isn't always going to be the case. So because of the expense recognition principle, we're forced to come up with some type of way to estimate the amount of deadbeats that exist in the period we make the sale. So if past history indicates, for instance, that 2% of our sales aren't collected, we need to estimate that amount in the same period as the related sale. We can't wait to find out that the customer is a deadbeat and is bankrupt and won't pay us, because we'd be violating the expense recognition principle under GAAP. So the problem, again, is that the company may not learn which particular customers won't pay until a future accounting period, so they're forced to come up with an estimate. So the way we do this is we use what's called the allowance method to estimate bad debt expense. The allowance method is based on estimates of expected amounts of bad debts, and it involves two steps. The first step is to make an end-of-period adjusting entry to record bad debt expense based on our estimates. And the second step is in subsequent periods when the deadbeat shows up and we identify them, we do a write-off to remove the receivable from the books. So in step one, we're estimating we might not get the money. Step two, we now know we're not going to get the money, and we would remove the receivable from the books. So how do we do this? Well, first, we'll talk about the adjusting journal entry. We're going to assume that Skechers estimated bad debt expense for 2017 to be $18,398. And then they'd make the following adjustment. Well, I like to do A equals L plus E first. So if we believe the customer isn't going to pay us, that's going to create an expense for the business, $18,398 in this case. And under the expense recognition principle, we have to record it at the time of sale. So this is an estimate. That makes net income go down and equity go down. But because we don't know for sure we're not going to get the money, we don't want to use the receivable account directly. We're going to use what's called an allowance account, which is another contra account. This one is a contra asset. which reduces my overall receivable balance. But we want to track it separately because remember, we have those subsidiary accounts with all the different customer balances. At this point, we don't know which of our customers are deadbeats. This is just an estimate. So we keep it in the allowance account, which is like a rainy day fund, right? It's the amount that we don't think we're going to collect from our customers, but we're not sure yet. So to do that in a journal entry form, we debit expenses to make them go up. And then we are going to credit the contra asset allowance account to make our assets go down. And as you can see at the top, our accounting equation does balance as a result of this. So this is representing the amount of customer accounts we don't think we're going to collect from the current year's sales. Again, we're not sure that this is an exact amount. It's our best guess, but we'll adjust for any deviations in future periods when we become aware of who the deadbeats really are. Remember, the allowance is a contra asset account. It means it's a negative asset. It makes assets go down. So as a contra asset go up, asset would go down. So as we increase our allowance, assets go down. And then the cost of this deadbeat expense would be referred to as bad debt expense, and it would increase our expenses, which reduces net income and equity. So then what happens later on when we find out that one of our customers went bankrupt? Well, we don't want to double dip. We record the expense at the time of the sale, so we don't want to record a new expense when we find out that the customer has went bankrupt. Instead, all we do is take the money out of the allowance account and out of the receivable account. Basically, what happens is you have the accounts receivable less the allowance, which is referred to as the net realizable value of account receivable. So let's just assume for simplicity, I have 1,000 receivable and the allowance is 200, giving me a net realizable value of 800. When I do a write-off like this, we're going to take, let's say we write off 100. We take it out of the receivable because now I know for sure I'm not going to get the money. And then we take it out of the allowance because it's no longer an estimate, it's a reality. Notice that before and after the write-off, the net realizable value stays the same. So accounts receivable represents the amount the company is entitled to collect. The allowance is the amount not expected to be collected. So then the net realizable value is the amount we expect to collect. So before and after the write-off, the net realizable value doesn't change. So really, write-offs do nothing. They have no net effect. That's really important to understand. Write-offs have no net effect. All they do is eliminate hope. Yeah, you heard me right. It eliminates hope. Before the write-off, I figured I was going to get $800. But I had a dream, my friends, that I could get the full 1,000 if I got lucky. I didn't think I'd get 200, so I thought I'd be at 800, but I had hope to get the full 1,000. After the write-off, once I've identified a deadbeat is bankrupt, they're not going to pay me $100, I still think I'm going to get the same 800, but my hope is gone. The most I could ever get if I get real lucky is 900 now. I still think I'm going to end up with 800, but the most I can get is 900. So some hope has been eliminated. But the net effect, as you can see on our accounting equation of that write-off, is 0. Please note, I don't want to confuse you, the numbers I used at the bottom were just for simplicity purposes. I made them all up. I didn't use the amounts that are included up for sketchers because that would make the math too challenging for my brain. But the bottom line is it has the same impact. When we write off the amount for sketchers, there's no net effect. All we're doing is taking it out of the allowance account, which is our estimate, and making it a reality by taking it out of the receivable, because now I know which customer isn't going to be able to pay. There's no new expense recorded at the time of the write-off. That's extremely important. We record the expense at the time of the sale, so we don't have to record any new expense at the time of the write-off. That would be double dipping, which we don't want to do. The matching principle says record the expense at the time of the sale. Then subsequently, when I find out I have a deadbeat, all I'm doing is removing the receivable and the allowance at that point. No new expense is being recorded. So again, I'm going to erase this real quick. So when I click the button, you can see what shows up, which is the point I previously made, which is that the journal entry does not affect any income statement accounts. And it doesn't change the net book value of our receivable. So again, write-offs do nothing except eliminate hope. That's extremely important to get used to. Bad debt recoveries happen sometimes, and what that is when we think we are not going to get money from a customer and we write it off, but then later on the customer surprises us and they pay us the money. Then effectively all we do is reverse the write-off that we previously made. So remember, the write-off was debit allowance credit receivable, so we do the opposite. We say, whoopsies, we made a mistake, and we put the asset receivable back on the books and the allowance back on the books because we were wrong. It wasn't that customer that was a deadbeat after all. So we reverse the write-off, and then we record the collection of cash. The collection of cash is going to make our asset cash go up and our receivable asset go away. These entries, like the original write-off, don't affect total assets or net income. All you're doing is making assets go up and down by the same amount. So there is no net effect, but it does impact the net accounts receivable balance. So remember, accounts receivable minus my allowance equals my net realizable value. So I'm going to make up numbers again. We have receivables of 1,000. I'll use those same numbers I used before. The allowance is 200, giving me a net realizable value of 800. If we write off 100, then we take out the receivable, we take out the allowance, leaving us with 900 and 100, or a net realizable value still of 800. If we recover, say 50, we're going to reverse the write-off. So we're going to add 50 to our receivable, add 50 to our allowance, which gives us 950 and 150, still a net of 800. But then when we collect the $50, it comes out of the receivable. The allowance isn't affected, so we're left with 900 and 150. So our net is now down to 750. So the net effect to assets is nothing, but when we collect that money, the net realizable value of accounts receivable does go down. Because if we collect the $50, we're now entitled to collect, or estimating that we'll receive $50 less because we collected that $50. So what's a summary of what we just learned? Well, there's two steps involved with recording bad debts. One is recording the estimated bad debt amount. When we do that, our bad debt expense goes up and our net income goes down. And then our allowance goes up, which makes assets go down. So in our accounting model, A equals L plus E, revenue minus expense equals net income. Expenses go up, which makes net income and equity go down, and then our assets go down when our allowance goes up because it's a contra account. So that balances us out. Then when we identify and write off the actual bad debts, all that happens is that our asset goes up and down. So we reduce the allowance, which makes assets go up. So let me do it this way. We decrease the allowance, which in turn makes assets go up. We decrease accounts receivable, which in turn makes assets go down. So the net effect of that write-off is zero net effect. There's no net effect. So how do our accounts receivable and allowance T accounts get affected? Well, I love accounting, but I feel that students generally don't like T accounts. So it's presented in a T account, but I'm going to give you an algebraic formula. Assets go up with debits, down with credits. Contras do the opposite, so they go down with debits and up with credits. So the formula for the receivable, and this should make some logical sense, would be our beginning account receivable plus any sales on credit or on account, minus collections, because if we collect the money, we're owed less, minus write-offs, because if we write it off, we're not going to get it, equals our ending account receivable balance. That's going to be an important formula for this chapter. Likewise, our allowance is going to start with the beginning allowance, the beginning deadbeats, plus new deadbeats we estimate through bad debt expense, minus write-offs, because it's no longer an estimate when it's written off, so it comes out of our estimated allowance, gives us our ending allowance. And that's another formula that's going to be extremely important as we move on in this chapter. I want you to go beyond just memorizing these formulas. I want you to ask yourself, do they make sense? And I think that they do. Our beginning receivables plus additional sales on account would increase our receivables. When we collect money, customers owe us less. That's why it's a subtraction. And a write-off means we're never going to get the money, so that's also why it's a subtraction to get our ending receivable balance. With the allowance, the beginning allowance is the beginning amount I don't think I'll get, plus BDE, which is the new amount I don't think I'll get, minus write-offs, which are things I know I'm not going to get, so it comes out of the estimated allowance account, and then that gets us our ending allowance balance. On the financial statements, the company is going to show their net receivable, which is the receivable amount less the allowance, and that represents the amount they expect to collect at the end of the period. And then we have on our balance sheet, you could see that the receivables are shown up net of those allowances. And then on the notes to the financials, we're required to disclose what happens to our allowance account during the year. So the additions, which would represent our bad debt expense, are shown, and then the deductions, which would represent our write-offs, would be shown to arrive at our ending balance. So that information is all disclosed on the financials, so the users of the financials understand what the makeup of that allowance is.